is a wash. They had some revenue raising things, they had some revenue costing things, but this was the big one, right? To get from 35 to 21 cost us $1.4 trillion. The second thing they did was they allowed for immediate expensing of capital expenditures. And what that means and why is that important? Well, here's the theory, and I will tell you that the economists that advise Congress and the staffers on Capitol Hill love expensing, right? So every time we've gotten a tax bill in the last 15 years, there's been some form of expensing in there. And so why do they love expensing so much? Because the economists that advise them tell them this is going to cause the economy to really rev up because people are going to buy assets, it's going to create jobs, you're going to have more modernization of your production facilities in the United States, people are going to work smarter, our GDP is going to grow quicker. I think why they really love expensing is it's a timing difference. Okay, so what expensing is under US tax law, typically when you buy an asset, you got to write it off over 5 years or 7 years or 39 years if it's a building or 15 years if it's a certain kind of property. Expensing says, the expensing we got as part of this tax bill, we're going to let you write it off in the first year. Okay, so now you rethink that decision. Am I going to go out and buy all of my people a new computer because I get to deduct that next year if I do? So if you're having a good year and it's November and you think everybody needs a new computer, you go out and you buy a new computer, you get to expense that all in November so you don't pay that tax that you would have otherwise paid, right? You don't have to wait for that expense to come back to you over 5 years. The government was going to give you that deduction no matter what. They were just going to delay it for 5 years. So the reason I say it's a timing difference is when you look at the revenue estimates, and that's what becomes very important when you're negotiating a tax bill, expensing doesn't cost very much, but economists think that it has a huge impact, right? So this provision actually, over a 10-year period, I think, was less than $100 billion, which sounds funny to say that less than $100 billion is not a big deal in the grand scheme, and it was not a big deal, though, as part of the tax bill. Less than $100 billion didn't catch the radar screen for a lot of people in a $1.5 trillion tax cut. So expensing was a big deal. We got interest deduction limitations, and this is important. This is the first time in the business sense in the United States that interest to banks, interest to domestic related parties is no longer fully deductible. We got a cap, if you will, on how much interest businesses can deduct. And you have to understand why interest is the preferred method from a tax perspective to fund a business. When you pay interest, you get a deduction. The recipient of that interest picks up income. You avoid corporate double taxation. So if I have a business and I can put my money in as capital, or I can loan my money personally to that business, I prefer to loan my money to that business because I'm going to get my interest income out and I'm going to pay one level of tax. If I put it in as capital, my business is going to pay tax, and then I'm going to pay tax again when I get a dividend. So you want interest, right? And people prefer to use leverage to grow their business. That's changing now because now you can only deduct a certain amount of your interest. So very important to understand. We got the system that ends lockout. So the idea was we're going to go to a system that allows you to repatriate money to the United States tax-free. So there's a section in the bill that's called, the territorial tax system. I would submit to you this. We got a territorial tax system, but it's not what we bargained for in tax reform. What we really, really got when you dig in, and I think people agree with this, is we got a worldwide tax system where you have to pay a minimum of about 13% somewhere in the world, and if you don't, you're going to make up the difference to the United States, okay? And if that's true, if you paid your 13%, you can bring money back to the United States without any additional tax. If you didn't pay your 13%, you're in trouble. So we did not get the system that everybody thought we were going to get where I can bring money back to the United States for free from any country, anytime. That's not the system we got. We got a much more narrow system. So that'll come up later as I talk. But what we also got in order to go to that system was we got the government said, look, we've been on a different system for a long time, right? So just to back up, for those of you who don't know, the way the US systems worked for a long time is you earn money outside the United States, you don't pay tax in the United States until you bring that money back to the United States. So if I'm ABC company and I've got a distribution company in the UK, and that distribution company in the UK does really well, I pay my UK tax, but as long as I keep that money in the UK and I don't bring it back to the United States as a dividend, I'm okay. I don't have any US tax. It was a system we called deferral. And it was why we had the lockout effect that I talked about. It was why nobody wanted to bring their money back to the United States. I mean, Apple's literally has, I think it's hundreds of billions, if not trillions of dollars of unremitted, hundreds of billions at least. And you look at the numbers that they paid on the repatriation, and the lockout effect was real. So in order to end that lockout effect, in order to get us to the territorial system, we got this redeemed repatriation. So what they said was, for years you've had these earnings locked out. Now we're going to bring those earnings back and we're going to tax them. And we're going to go through this process of having a one-time tax hit. And that is happening today as we sit here. If you watch earnings reports, or if you work for a company, you know what's going on. It's the one-time tax calculation. It happened December 31st, 2017. Every US corporation that had unremitted earnings has to include those earnings in income, and they pay tax on those earnings. They don't pay tax at the full 35% that they were supposed to. They pay tax at a lesser rate, but nonetheless they have to pay tax, and they have to provide for that tax on the financial statement. So if you pick up the Wall Street Journal, you'll see all the heavy hitters are reporting how much tax they think they have to pay, and the numbers are staggering. So big windfall to the government, but an acceleration of tax for a lot of businesses, an acceleration of the need to part with some cash. So interesting policy choice there. NOL changes, they slowed down the ability of US companies to use their net operating losses. That's important because that's a cash tax cost to US companies. Carried interest, I don't want to talk a ton about carried interest, but carried interest was, I put it up there because it's interesting for this reason. I watched at least 3 debates during the 2016 election where both sides promised we will end the benefit for carried interest, and there was no ambiguity about the statement. And when we got to tax reform, we modified the benefit for carried interest, but it still very much exists. It just said you have to hold your asset for 3 years as opposed to 1 year. So carried interest lives on. Congratulations to the private equity lobby. They got it through. So I find that interesting. I don't think carried interest is the devil, but I just think it's interesting that was the one thing that everybody agreed on and it didn't get done. And then state tax changes that are coming. We all know on the individual side, we lost our ability to deduct a lot of state taxes that we used to be able to deduct on our itemized deductions, right? That's now limited to $10,000 when you combine your property taxes and your income taxes. But what's really interesting is what's happening on the business side and what states are going to do. States are starved for revenue. States can't afford to give people everything that the IRS is, or the Congress wants to give them from a federal perspective. So things like expensing. States probably aren't going to follow those rules, so there's new complexity there. What are states going to do about the one-time tax? And then just on a broader picture, when you look at the states now, if you live in a state that's 5% and the federal rate's only 21%, your state tax burden is just a lot more of your tax burden now. So understanding the impacts of the state rules as they apply and the economic impact on the states of the tax reform bill is going to be interesting to watch unfold. And we're seeing a lot of states scramble now to make changes to their rules to try to be competitive. And then for those of you who followed this debate, the pass-through deduction. So this is the situation where there's corporations, and we were cutting the corporate rate to 21% from 35%. But you've got this whole other part of the economy, which is a huge part of the economy. I mean, if you think about it, most of the businesses, I think more than half of the gross receipts of the businesses aren't in corporations. They're in pass-through businesses. So sole proprietorships, partnerships, S corporations. And in those businesses, people pay tax on their business income in their personal tax return at their personal tax rates. And so there was this debate, and Grant Thornton was very active in this debate, about why, if I operate my business, why, if I have a mechanic repair shop and I'm organized as a corporation, should my business income be taxed at 21% ostensibly giving me a break so that I can hire more people, I can have jobs, I can make my business better. But if I operate as a partnership or an S corporation, I'm subject to tax at 37%, not 21%, because the highest individual rate would be 37%. And so Congress attempted to fix that by creating a special deduction to get the pass-through rate down lower. So the pass-through rate is actually down just below 30% for most people. I will point out selfishly that they carved out accountants out of that benefit, so we do not get any benefit from the pass-through rate, which is fine by me. They also carved out lawyers, so that made me feel bad. So here's kind of the details of everything that's in there that I just kind of I walked through. But again, I think the important thing to remember is the 21% rate is the majority of the savings. It was all about creating free cash and capital inside businesses so that those businesses could reinvest as they went through. And then I think it's important to understand in detail some of the other international provisions. This is an international group, right? So I want to talk a little bit about what they did from an international perspective. And this is important. So we talked about, I call it a quasi-territorial system because I refuse to say that we have a full territorial system because we don't. We have a quasi-territorial system. We talked about the one-time tax. That's the tax on the money that comes back one time. But they got concerned about this, right? They got concerned about if we create a system where, okay, now you can earn money outside the United States and you can then bring that money back to the United States and not have any tax, right? Because they created this territorial system. They got nervous because they said, well, geez, when we had the system where you had to pay tax if you brought money back to the United States, everybody shifted their income outside the United States and just never brought the money back. If we don't tax them now, what they're going to do is they're going to shift all their income outside the United States and they're going to bring it back tax-free. So we have to put some curbs in, and that's when they put in these provisions. And somebody at the Senate Finance Committee has a very good sense of humor because they identified the type of income that's earned in foreign corporations that they wanted to be quote-unquote tainted income and subject to US tax. And so they named it Global Intangible Low-Taxed Income. And then they quickly identified that the acronym would be GILTY. So, and this no lie. I mean, when the Senate version of the bill dropped, it was it was like mid-December, and it was they always sent them out on like 8 o'clock on Thursday night or Friday night after I'd made plans for the weekend. And I got this bill and I was reading it. It was about midnight. And I got to this section and I read it again, and I thought that's just great. Somebody's really got a great sense of humor. I mean, they went out of their way to name it that. I can't believe that just happened, right? So anyway, GILTY is the provision that installs this minimum system. But without getting into all the details, let me tell you what GILTY really does. The way you avoid GILTY is by making tangible and property investments outside the United States. One of the exceptions to the GILTY provision is that you're allowed to earn 10% of your tangible property investment, so depreciable property investment, outside the United States, and it's not considered to be GILTY income. I think this was one of the most curious results of a tax reform that was supposed to be about creating jobs in the United States, encouraging investment in the United States. Because you look at this provision and you say, every tax planner in the world is now advising their clients that, hey, the more you can invest in a plant in country X, the better you're going to do from a GILTY provision. So I understood the need for the curbs, but the way they accomplished it with the GILTY provision is a little bit curious from a what we set out to do standpoint. And I'll just kind of leave it there on that. The last thing they did was, well, two last things. They did do something I call GILTY the stick. Okay, that was the stick that they were going to beat people with who misbehaved in global tax planning. They also gave us a carrot. So they said we don't want to just disincentivize you to do something. We want to incentivize you to do something else. And what we're going to incentivize you to do is to export, right? So they gave us something called the foreign-derived intangible income deduction, which is a really fancy way of saying we're going to give you a tax break if you export product from the United States, okay? And the reason they keep saying intangibles is they want you to keep your intangibles in the United States and not put them outside the United States. So this is a little known fact, but if you're a US business, you don't have to have a foreign owner, you don't have to have a foreign subsidiary, you just have to be a corporation. If you have exports of product or services, there's a provision in this bill that'll give you a deduction for 37.5% of that income. That means your effective tax rate on export business, so products that are sold for use outside the United States, is 13.125%. That's a really good tax rate. That's a really big incentive to export from the United States. But I'll tell you what's curious about it. There's no requirement that you actually manufacture what you export in the United States. So, yeah, you're with me, right? So you could make some stuff in, I don't know, Mexico, right? For as long as NAFTA lasts, right? And you get a pretty good deal. And you can bring that stuff to the United States and you can sell it to your customers, and the margin that you can leave in the United States on that transaction is going to be taxed at 13.125%. So I find that interesting, right? Because as a tax planner, it doesn't necessarily incentivize me. I mean, granted, if somebody comes to me and says, Greenfield, where should I build a plant? My answer might be the United States for tax only. But they're going to not just talk to me, they're going to talk to a lot of people, and they're going to come to find out that, geez, labor's cheaper in other places. There's better supply chains to materials. Let's face facts. Changing our tax bill didn't change the worldwide supply chain. I mean, if you're making socks, your supplies are in Asia or some in Mexico. Little known fact: colored socks come from Asia. So if you're wearing socks that have like red or green in them, white socks generally come from Mexico. Something about the yarn. I didn't know that, but I have a big sock client. And they explained that to me, which I thought was very interesting, that apparently the yarn and the dyeing process is much more Asian driven. And so the Mexican sock market's like way down, because guys don't wear white socks to work, right? I mean, everybody's got these fancy colored socks now. So anyway, but the point being, that's an example of the supply chain, right? You can't just start making colored socks in Nebraska or wherever you'd want to make them in the United States, because the supply chain's not there. So you're going to keep making them where the supply chain makes sense, where the labor cost makes sense. So you're going to start doing tax planning to say, well, I actually made them there, but I sold them from the United States, and that's foreign-derived intangible income, and I only got to pay 13% on that. Because 13% is a good rate. That's like an Ireland level rate, right? Ireland's like 12.5, so 13's a good deal. And then the last thing they did was, and this is another great acronym, is they put in something called the base erosion and anti-abuse tax. And remember I talked about inversions, and I talked about companies getting out and wanting to be foreign owned. And I know we have some people in the room that have foreign parented organizations. And so typically when you're foreign owned or you have a foreign parented organization, the holy grail of tax planning for those organizations was you leave as little profit in the United States as you possibly can. Why? Because we had a 35% tax rate, and you could shift that profit to another jurisdiction through an interest payment or a royalty payment, and you'd pay tax at the lower rate, and almost wherever you picked. So out of concern for that, the IRS designed something called the base erosion and anti-abuse tax, which is called BEAT, B-E-A-T. And the idea there is it's a parallel tax system where they don't allow a deduction for payments that are made to related people. And so it's a nasty tax system if you fall into it. And it's one that a lot of inbound companies are significantly impacted by, and one that was very controversial, to be honest with you, and continues to be very controversial from a WTO perspective, and continues to be very controversial from a treaty perspective, because we've negotiated a lot of treaties and told people that we wouldn't double tax them, and this is double taxing somebody. If you don't give them a deduction in the United States and the income's still taxable in the other country, and we have a treaty with that country, we double tax somebody. So I will point out that the tax law has some questionable stuff from a WTO perspective, from our requirements under the General Agreement on Trades and Tariff. And for the academic types in the room, if you've thought about that, we've not been free from our WTO problems in the past. We've had some issues with some other things that we've implemented that we've had to unimplement and replace. And so I wouldn't be surprised in the next 5 years if we see some activity on the WTO front. Granted, it takes about 7 years for them to really rule on anything. 5-7 years is kind of the typical. So it'll be a while we'll be able to do this, but not free from that perspective. So now I'm going to move into my insights, and then if there's questions, can I take questions? Is it okay? So the 21% rate, what does it really mean? So I get this question a lot from my clients, and it goes like this. My rate was 35 last week, and it's 21 this week. Does that mean that for every $100 I earn, I'm going to have $14 more to spend? And the answer to the question is no. It's more complicated than that because they took away a bunch of deductions. So what we did, because I don't like to let the people who work for me go home, is we sat down and we modeled out a couple of different businesses, right? And we think, and this is not scientific, we think that the real savings is probably somewhere around 8, maybe 12 in some industries, okay, of real effective tax rate change. Your results may vary depending on how it impacts your business, but we think that the real effective rate change that you're going to see from a financial statement perspective is 8, maybe as high as 12, but most people are going to be 8, 9. So that's exciting when you think about that. That's a significant number. That will change some behavior if you have an 8 or a 9% rate cut. So that's interesting. Did we get pass-through parities, or did pass-throughs get left out in the cold? I will tell you this, if you have a pass-through and you're an international business, you're out in the cold. You need to get some help immediately. If you're an S-Corp and you've got controlled foreign corporations, or you're an S-Corp and you've had branches, get some help because pass-throughs got left out in the cold on a lot of the international provisions. To the point where I had some pass-through people call me and say, there's been a mistake in the bill, and we need to talk about getting a technical correction done. And it's like, no, they intended to do this. And so pass-through provisions, pass-throughs got left out in the cold. Capital expenditures, is it a jump start or is it a temporary incentive? I look at capital expensing like this. We had 50% capital expensing. They started that, back, I mean, it's been, years ago, right? 2008. Thank you, Mario. That's very good. Yeah. So we've had this for a long time to try to spur people's capital investment. And my answer is this, and it might be maybe too simplistic, is you only need so many computers, right? You can't just keep buying your staff a new computer every year to get the tax benefit. So the point is you're only going to rehab your business and spend money on capital so much as it makes sense to modernize your business. And so I think maybe we see a temporary bump in spending related to this. I think some people accelerate capital expenditures. This is actually an area where I think that a lot of provisions, by the way, in this expire. That's important to remember. And I think that the expiration of a lot of these provisions is actually an area that helps capital expenditures, because I think people are going to look at this and they're going to say, I've got a window to get this benefit, and so I need to use it. And so I've talked to a lot of big companies that are accelerating their CapEx spending and trying to find ways to get more money so they can do CapEx when they can get the 100% deduction. So temporary or long-term. Impact on M&A activity. I think there's going to be a significant change in the way we see M&A done and the way we see targets. And I think this is going to be beneficial for US companies when global investors are looking. And the reason is this. If you can buy the assets of a US business, not the stock, but the assets of a US business, or get a transaction where it looks like you bought the assets of a US business, the amount that you attribute from a purchase price perspective to tangible property, you're going to get an immediate deduction for that. That's a big deal. That is a big deal when you're modeling a deal. If you're looking at two different jurisdictions, let's say I need capacity and I'm a sock maker, and let's say I need capacity and I'm looking at two plants, and one's in Alabama and one's in Canada. In Canada, I'm going to have my tangible investment, and it's going to have to be written off over 7 years, so there's cash tax cost to that, right? In the US now, because of the new expensing provisions, and they allowed expensing a used property, I'm going to get that immediate deduction. So I think you're going to see an impact on M&A activity. I think you're going to see an edge to US companies if you can get asset deals done just on that part of the M&A activity. So the debt curbs, I think this is actually probably in the global economic sense a good thing, but I think you're going to see less debt at US companies. And here's why. First of all, we used to always put debt at US companies because you got your best bang for your buck. You got a deduction against 35% income. It saved you the most tax money. Depending on, you could compare where else you might put the debt, but everybody else had a lower tax rate. So now that's not the equation anymore. And you've got a limitation on the amount you can deduct. So I suspect as people's debt facilities come due, which on average happens every 3 to 5 years for most businesses, I suspect that what people are going to start to do is they're going to align their external debt more with the profit centers of their business. So if the majority of their income comes from the UK, I suspect what you're going to see is you're going to see local UK borrowing, or you're going to see them going at least to, I guess with Brexit you can't really promise it'll be UK borrowing, but you're going to see them go to a jurisdiction that would lend on the UK cash flows, as opposed to putting that debt in the US and pushing it out around the world, because the US can't now be overburdened relative to their income level. So that's going to be a very interesting phenomenon that we're going to see. Banks have already seen a significant decrease. If you listen to some of their earnings calls recently, banks have already seen a significant decrease. I follow a lot of people on Twitter, and one of the guys, somebody posted, an economist for Goldman, I think it was, posted, banks have seen a decrease in lending activity, and they call it on their retail bank side, and they can't figure out why. And this tax policy guy responded and said, well, do you think it's because Congress took away everybody's incentive to borrow? I mean, that's the net effect of this, is it's just no longer the slam dunk way to do it is to go out and get US debt. So I think that debt placement in a global sense is going to be very interesting, and how we see the global credit markets develop in response to that is going to be interesting, because remember, when there's demand for credit in a market, that means there's demand for capital in a market. That means the cost of capital in the market goes up, and it makes a developing market a better investment decision for pension funds, hedge fund money. And so we've kind of given up a little bit there, if you think about it, right? If we wanted to attract capital, the debt curbs maybe work a little bit against us. But I think it's overall good not to have as leveraged US companies. So maybe a push. Net operating loss usage. I don't think this is going to be a huge deal. I think we kind of had this before in the alternative minimum tax, but I think that you're going to see companies, obviously this is going to affect what people do to plan around accumulation of net operating losses. The other thing that I didn't point out, this is kind of exciting, net operating losses that are generated after 2017 now have an unlimited carry forward. So they never go away. It used to go away in 20 years, and they did away with that, so it never goes away. So I think this is going to probably be not a huge deal, the limitation that they put on NOL usage. So I think on the international side, I think I've shared this with you already. I do think that our territorial system is inferior to the rest of the world's. By inferior, just to be clear, I mean not as good. Do I think it was worth the wait? I was disappointed, right? I thought we were really getting a territorial system. It was like game on as an international tax planner. But we didn't get that. We got a worldwide system with a minimum tax. And so to whatever extent we thought a territorial system was going to make us competitive, I think we still struggle with that. We talked about the guilty as the stick and the fitty as the carrot. And I think that the guilty stick, I have problems with the behavior incentives there. And that's really what this is about. I think you're going to see economic behavior change in a non-positive way as a result of these provisions. Base erosion planning, I will leave the comment here. I think it's a good provision. I think that people who are content to base erode are going to find another way to base erode. So, and then complexity. They failed on their promise to give us simplification. I will tell you that the system was complex in 2017 when this process got underway, and the system is infinitely more complex now. You will see real increased burdens on US businesses to comply with these laws. You will see people fail to comply with these laws and then have risk from a financial statement perspective and cash tax risk when the IRS finally gets around to auditing The only hope we have is that Congress continues to underfund the IRS and they can never audit us. Hear, hear, yes. So I have a lot of good friends at the IRS. I want to thank you all for your time. I'm happy to take questions, or if you're all ready to go home, then I'm happy to let you do that too. Question?
With reduced propensity to borrow because of the interest cap deduction, and you take Fed's policy into play, how do you see that balancing out?